you believe that overfunding whole life insurance is totally unnecessary.
Yeah, I just don't believe in overfunded whole life as an asset. I've got 4 different talking points that I believe are a much better investment or a way to store wealth, if we don't want to use the term investment, rather than parking your extra capital in an overfunded whole life policy.
What would make you a whole life believer?
Comparing overfunded whole life to a high yield savings, that does have merit. I'm going to minimize the death benefit and maximize what's in it for me. It just doesn't even feel like life insurance in it.
I think the market underperforms for most people.
What a lot of clients don't understand is that's going to get eaten away by inflation.
You told me if you can convince me otherwise, I'll take the shirt off.
I think I need to take off this sweater.
No. Keep it on. Dan Riggs, welcome to the BetterWealth Show.
Hey, it's a pleasure to be here.
We at the BetterWealth Show don't want to just be all talk. We want to be able to have conversations with people that may disagree with what we're bringing up or the type of content that we make. And you're an example of that. You actually have a lovely costume that I actually love. Love the fact that you came prepared. I love that. And the costume is unnecessary because I believe, I don't want to put words in your mouth, but that you believe that overfunding whole life insurance is totally unnecessary. And you told me jokingly, if you can convince me otherwise, I'll take the shirt off. So
I've got more shirts underneath this.
We're not stripping down. We're not stripping down to skin on the BetterWealth Show. But first of all, I want to thank you so much. It's always easy to come on a show and everyone agrees, but I really appreciate your willingness to come on and bring ideas that you may or may not agree or disagree with. And my hope is that this elevates conversations, financial IQ for people, and encourages people to be okay with talking to people that might not agree with everything that you say. So I'm very comfortable having this conversation, and I think we're both going to learn a lot from this. So without further ado, why don't you just set the stage? And then I know that you have 3 key points, and I'm sure that we can unpack some other things. And so I'll hand it over to you.
Did you want to hear a little bit about my background and how I got into life insurance?
Yeah, let's hear a little bit about your background, and maybe why don't you set the stage on how you originally got on my radar to begin with and reached out, because that might give context to be like, who's this random person with an unnecessary sweatshirt on? That might be helpful as well. So we'll dive into that.
Sure. So I'm a fairly new insurance broker in the business. I am in the top tier of my agency, not because I'm good at it, just because I put in more effort than probably an average agent might. And as a nerd, I'm always trying to learn. Just before I clock in for work, after I clock out of work for the day, I'm watching YouTube videos in our insurance space, trying to learn more about this beautiful business that we're a part of. As an agent or a broker, you don't have to know that much. There's so much that goes on behind the scenes with how the carriers operate, how they do underwriting, and different things. So I'm always trying to learn as much as I can about the insurance space so I can get better and help more clients every day, every week, every year as I continue to build my personal production and then also build a team. So I follow some of the other large YouTube channels in our insurance space. Not going to name them, just going to give a shout out to BetterWealth. But I stumbled upon BetterWealth maybe just a month ago. I had never heard of you. I was thinking, who's this kid with a beard? No offense.
No offense taken.
I could tell you're a really intelligent guy. You speak eloquently. And in the few interviews I've watched that you've conducted, you did a really good job of kind of playing it down the middle and also politely pushing back when one of your guests might say something that you don't agree with or you think that there's a better way. So I caught the very first video I saw of BetterWealth was one of your videos with Mr. Burr. And the title of the interview was how, I believe, correct me if I'm wrong, how I used whole life insurance to get rich. And that just set off the baloney meter in my brain. I said, I'm watching this video. I'm going to watch it to the end. That's a really good title, by the way. Someone who doesn't agree with you.
The job of titling and thumbnails is to get people to click and watch. But yeah, continue.
You've got a very good team behind you.
Yeah.
So I saw that title, and I'm assuming someone who might agree with you might only watch 5 or 10 minutes. I watched that whole hour and 6-minute video or however long it was. And my baloney meter just kept going off as I'm watching the video, and Mr. Burr is saying things. And, I don't know him. I've never met him. I respect him utmost as a man, as a Christian, as a father, as a hard worker, as a real estate investor, as a businessman. On the personal side, he has wonderful things to say. I just don't quite agree with his strategy of how he stores his wealth. And I just wanted to politely push back on that. Unfortunately, when I left that comment, I was going through a rough patch. I just lost my grandfather, who was my best friend in the world. Still hurts that I lost him. I can't pick up the phone and call him every day for advice. But I was going through a rough time, and I left a very rude comment on the video. I edited out the rudest parts of that and still stuck to the substance. So the rude parts are gone, but I just didn't agree with really almost anything that he said. I did agree with a couple things with real estate investing, of course, incredible way to build wealth over the long term. But I did not agree with how he was presenting the concept of using overfunded whole life insurance. So just the title of video, how I used whole life insurance, or overfunded whole life insurance in his case, to get rich. And I said, baloney. That's not true. That's not true at all. He uses overfunded whole life insurance as I'm not going to call it an investment, because you agree overfunded whole life insurance is not a traditional investment, but how he uses it as a store of wealth. My personal investing strategy, it differs from that. I don't believe that's the best method. I believe there's, at least 3 or 4, I've got 4 different talking points that I believe are a much better investment, or a way to store wealth, if we don't want to use the term investment, rather than parking your extra capital in an overfunded whole life policy. However, this strategy does take some investment knowledge. I don't have a degree in finance. I have a degree in management. I'm a finance nerd. I've been glued to CNBC for the last 20 years. I'm telling you, I can't describe how big of a nerd I am. When I wake up in the morning, I'm checking every update I missed overnight from CNBC, Fox Business, Bloomberg, Yahoo Finance. I just want to know what's going on in the markets, so I know exactly what cycle of the business cycle we're in and where I should be placing my money, investments, or storing my wealth. So, did you want me to unpack that, or did you want me to give you a little bit of background?
You would agree that most people won't do that. So that's awesome that you're doing that, and majority of people, that would give them anxiety looking at, trades and all. So I think that's great. I think I would love to know why you're passionate about life insurance, because yes. I think that's okay. You're painting the picture, but you have a passion for life insurance, which I think makes your story very unique. And so why don't you talk about that, the type of life insurance that you like, and then we can dive into the four talking points.
Sure. Yeah. If I could answer your question, then give you a little bit of background of how I got into the space and why it's so important to me, and why I think it's so valuable, the concept of life insurance. So I work for the agency that I work for. We specialize in mortgage protection. So our leads are mortgage protection leads. However, 70% of our business is final expense. So we're still, 70%, overwhelming majority of our clients are getting a final expense policy, just because typically that's, only all what they qualify for at their age or their health condition. So personally with my clients, I will only recommend a policy that includes some type of guaranteed payout from the insurance company, whether that's a final expense whole life policy where we're limited to a $50,000 death benefit, tax-free death benefit with the carriers that we work with, or if there's someone who's generally under 50 years old and good health, I'll recommend term with return of premium, meaning the cashback option. So if they pass away in the next 30 years, their family gets potentially hundreds of thousands of dollars. If they outlive the policy, they're going to typically get a refund check back between $20,000 and $40,000 tax-free. And there are carriers that we work with that will refund 100% of your money that you put in. So every single penny. You can also go with a 75% refund amount on the return of premium, increase your death benefit a little bit, but try and find out where that client's at, what their situation is, and where their needs are. If they need a bigger death benefit up front, or if they'd like a bigger refund check heading into retirement. So my personal point of view is I'm only recommending a policy to clients with some type of guaranteed payout. I don't agree with many things that Dave Ramsey says, other than one thing he does say is buy term and invest the rest.
Yeah.
That is a great concept.
Yeah.
if you understand investing, if you understand the specific market sector where you're placing your dollars. My father's a great example of someone who doesn't know anything about investing. He was very successful in his career, built a construction company. He has a multi-million-dollar net worth, but he doesn't know anything about investing. And he may actually be one of the very, very few cases that I believe overfunded whole life, and I got to swallow hard. Overfunded whole life.
It's only been 10 minutes. Don't give me that. You got to do better.
He's the only case I can think of. He's the only one I could think of that overfunded whole life may be an option for. Other than my father, I can't think of anyone else I have ever met where overfunded whole life.
Yeah. So in a way,
the best option.
you just want to repeat what you're saying. It's like, if you have any it factor at all when it comes to investing your money, you think overfunding whole life. I would assume you're thinking the same with index universal life as well. Like, you would not use that. There's better ways that you could save, invest, grow. Is that, am I characterizing that properly?
Yeah, certainly. So our agency just got into IULs recently within the past year. It's not something I've focused on. I've never sold an IUL policy. I've been through all the training. I just, as an investor myself, I would never buy an IUL for myself because I can make outsized returns in the free market over what you could get through an IUL. I think an IUL is a great investment for someone like my father who doesn't know anything about investing. He doesn't care about it. He's more comfortable taking his nest egg, turn it over to a competent money manager, and then watching that grow. But of course, his returns are probably half. His APY is probably half of what I'm getting on my investments and my strategy. Yep. So I think you had asked me how I got into the business. My story has been pretty wild, and I hope I don't get choked up talking about this because I usually do. So forgive me if you see a tear. 5 years ago, my life changed forever, and it was a very negative experience. I went through the world's worst divorce. And I've told my story to other single men who say, oh no, mine's better. And I spend 30 minutes telling them the story. They're like, oh my gosh, how did you survive that? So it was a devastating experience. Me and my ex-wife, we grew apart. She's a good woman. I'm not sure that she handled the divorce as good as maybe she could have. But what happened is I have a little service business, not little, but it's medium-sized service business here in the Phoenix market. And I started that about 15 years ago, right after I got out of college, and found out the corporate world was not for me. I'm not a cube person. You stick me in a cubicle, I'm going to die a slow, miserable death. So started a little service business, spent about 15 years growing it. Bought a nice big 2-story house in a very nice neighborhood, brand new cars, money in the bank, 2 babies. I've got 2 young daughters with my ex-wife. Life was going really, really well. And then one day she told me, I don't love you anymore. So that wasn't the end of the story right then. We were still living together. We were in separate bedrooms. And then in the middle of the night, one time it was about 9 o'clock at night, I hear a pounding on the door. Bang, bang, bang. Police open up. And I'm like, what the heck is going on? Like, I'm a straight shooter. I'm a Christian guy. Wouldn't have an insurance license if I ever got myself into trouble. So I opened the door up, and Gilbert police had a conversation with me and held up a piece of paper. Earlier in the evening, me and my ex-wife had gotten in an argument over custody because we knew we were not going to be staying together. We didn't know what the future was going to look like for our 2 young daughters. And her position was she'd get 100% custody and I get nothing, or, just visitation here and there. Well, I guess she had been concerned about she might lose full custody and have to split custody with me. So the prior calendar year, she hired a lawyer, had a lawyer write up a false document, submitted it to the court. And I found out through my own lawyer, the only loophole that's possible to do this was she claimed abuse. She claimed I was abusive to her and the children. I was an immediate threat to my family. She had filed this against me the prior calendar year. We'd been living together as a family, I thought a loving family, for about a year, and she did this just as a ploy to try and secure custody. So I hear bang, 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 answer the door. It's Gilbert police. They held up a restraining order, and they said, you have 10 minutes to vacate the premises. So in the middle of the night, I had to pack a suitcase. I grabbed one of our 3 pugs. I could only take one with me. I had nowhere to go. I got in my truck with nothing but the shirt on my, excuse me, sorry, with nothing but the shirt on my back and the suitcase I had in my truck and my little pug Ruby. And I drove to Las Vegas in the middle of the night because I had friends there. I pulled over on the side of the road as I was driving to Las Vegas, and I called my grandfather and I said, I want to quit. I want to give up. I don't want to go on anymore. And he talked me off a ledge and helped me be strong and gave me advice and told me he's still my best friend and always will be, and he will always love me. And he said, you got to get through this. You've got to pull yourself up by the bootstraps and get through this. So I drove to Las Vegas in the middle. Sorry, let me take a drink and regain my composure. Drove to Las Vegas in the middle of the night. Had nowhere to stay. Just checked into hotels, stayed in hotels for a couple weeks. I had money, I still have my small business. I was getting residual checks every week from my business partner who was running and still manages the business. So I wasn't broke, but I've always been a cheapskate. So instead of renting a nice house or doing anything traditional, I'm really good with money, and I always have been. I rented the cheapest room I could find in a decent neighborhood while I was trying to rebuild myself mentally. I ended up staying in Las Vegas and planting roots a little bit. I didn't know what to do with my time. I'd wake up every day and have nothing to do. I didn't need to get a job. I probably should have. It would have helped me heal from my wounds from the divorce and losing my children. But what I did, I picked up on an old hobby I had in college, went through a professional training program, and became a full-time professional blackjack card counter in Las Vegas for about 2 years. I couldn't work a job. No one would hire me. I never even applied for an interview. I probably would have broken down in tears like I just did a minute ago. I was not well. I was not, mentally put back together. And thankfully, my faith in God, being a Christian and praying all day long, every single day, and the advice and the counseling from my grandfather kept me sunny side up and kept me from making a very terrible decision. So I couldn't work a job, but I could still do math. So I'd go to work to the casinos. I would play the night shift because little secret to any aspiring card counters, the casinos put their worst staff on the graveyard shift. So if you're looking for the sloppiest dealers, the sloppiest pit bosses, the sloppiest table games managers, sloppiest surveillance, sloppiest security, you're going to have to work the night shift. So I did that for about 2 years, and I did well. I didn't do nearly as well as I planned because there's what we call negative variance in card counting, meaning you can have a bad run. It's not gambling. You're using probability to place the bet in your favor. And I had some stretches where I lost significant amounts of money. I remember I went to Vegas at the time, towards the end of the 2 years I lived and worked in Las Vegas as a card counter. Things started to warm up a little bit with my ex-wife. She allowed me to have visitation with them. So I'd go to Las Vegas for a week, put in a full 7 days of work as a card counter, drive back for a week. And things were better then. She was letting me stay with the children, stay with her and the children so I could maximize my time with them. But I remember one of my weekly work trips to Las Vegas, I went to Las Vegas for a week and I think I lost 12 to 15,000 and then had to drive home. Yeah. I didn't have the time to stick around and make it back. I only took that much money with me on the road. I didn't keep the money in a traditional bank account or an overfunded whole life policy, and had to drive back with my tail between my legs. That didn't end my career, but the swings of being a professional card counter, there's very few.
How did that get you into the insurance space?
I was lost. My grandfather did not believe at all what I was doing with card counting. He's like, what are you doing? You're wasting your life. You're a smart guy. You've got a little business. Focus on your business, get a corporate job. I just couldn't find anything that fit me. And I ended up moving back here after I got sick and tired of living and working in Las Vegas. Moved back here, was just running my service business part-time, helping out with marketing and promotions and stuff, and started applying for traditional 9-to-5 corporate jobs. I've got a degree in construction management. That's a very good paying industry if you're looking for a salary 9-to-5 job. And started just applying. And I submitted over the course of about 3 months, hundreds of applications, couldn't get a single call back. I thought my resume was decent, you know. I'm going to try to say self-made, not like I'm some big shot, but started my own little business, had some amount of success, was doing okay, and had a track record of 15 years of building a business literally from zero. When I started that business straight out of college, I was deeply in debt. I had nothing but my truck and a little bit of equipment, and started with nothing, didn't even have a website, and was able to grow it steadily over the years. And I thought that looked good on a resume. And turns out if you're applying for a corporate job, they typically want to see a long track record of you being a corporate yes man. And I didn't have that. My corporate experience was 15 years ago before I started my small business. So I couldn't even get a call back for an interview. So I was just applying to jobs, and then found a job, just a sales job. And I was looking for something started looking for something in sales, knowing that I'm a pretty decent salesman. And I mean, why wouldn't you hire me if I'm 1099, 100% commission? There's no risk to you if I'm not great at this. And was applying to sales jobs, almost went into solar, almost went into a different home services business, and then found a job ad, and I saw the income potential, and I was thinking I could live off of that, for what they had put in the job ad, and applied to it, and got the interview, which was my first interview I'd had in the 3 months of my job hunt. And got within 3 minutes, my upline manager says, you know what, I don't even need to run through the rest of this interview. You've got the job. You know, I told her, she asked, what did you like about our agency? I said, well, I found out you guys have a YouTube channel, and I watched every video you've ever made. She says, you're hired.
Yeah, awesome.
So I got into this business. And at first it was just a sales job. I was just looking for something. I was looking for my next chapter in life. I was looking to heal from my depression and the devastating loss of losing my family, having to move out of a big home, and life resetting. So at first it was just a sales job. And the farther I've got into this business within my first year, I realized, holy cow, I'm really helping people, especially if I'm recommending them something with a guaranteed payout from the insurance company. You know, 70% of my clients don't have a high net worth. They don't have a $250,000 or $500,000 house. So many of my clients took out a home equity loan on their house because they can't even make the bills, or they can't fund, you know, a project around the house. So many of my clients come from that space where they just don't have money. They probably don't have a 401k. They certainly don't have, you know, real estate investments or investing in other aspects. So, you know, the farther I got into this business within my first year, I realized, like, this is absolutely incredible that we're able to do this. I'm able to make, you know, this first year in business, when my small business, I never paid myself a substantial income because I was always reinvesting, always buying more trucks and more equipment and hiring more employees. So I never paid myself what I could have, or maybe what I should have. This first year in life insurance, first year I've ever made $100,000 in my life. And I'm the first one to admit, I am not good at this. I am absolutely not good at this. My appointments, I'll stumble over words. I'll screw up part of my script, but I'm willing to put in the hard work and effort. And it feels so good at the end of the day that, you know, what I do matters. What we do matters, helping people not only guarantee their family's future, but being able to provide very well for them after they pass away.
All right. So let's get into your 4 points. But before we get into your 4 points, I just want to explain final expense and return of premium term. So you may not know this about me, but the first business plan that I wrote up was actually a final expense call center. I don't know if you know that.
Yeah.
I was working at the bank, was very interested in all kinds of different business models, and talked to a gentleman who runs, you probably would know him, runs a large call center in Michigan. And I was fascinated by this. And this same gentleman was the person that told me to read Think and Grow Rich. And so went down that path. I had a mentor who was very instrumental, who actually owned a call center, got to shadow some people there, talk through. And I talked to a lot of funeral homes, and I'm sure you guys do things different, but the reason I did not go down that route is I realized that, like anything, there's the good people and the bad people, and there's a lot of people getting scammed or a lot of old people that have no clue what they're buying through call center, And so it was one of those things where I was excited because I was like, man, we could scale this. The underwriting's easy. It's like, I was looking for like opportunities and business models, and I'm sure if whatever you do, you can crush. So I know maybe a little bit more than the average person about final expense. And I decided not to necessarily go down that route, mainly because maybe it was the few funeral home people that I talked to, but that they just said like, hey, like, yeah, there's some things that are good. And then there's people that, buy these things and then they don't know they bought them, or they got overpitched and they don't even like, they don't know what to do, or the family doesn't know what to do and they pass away. So we don't necessarily need to go too far into that. I think final expense is a great product for people that have nothing and make sure that they're not a burden. The other thing that I want to say when it comes to return of premium is it's interesting. Return of premium, term insurance, the concept is if you pay over a 10, 20-year period of time, at the end of that time period, there's probably a 99% chance that you're not going to die, which everyone wins. And instead of the insurance company just like going on your ways, they return that premium. And you said that there's a rider for 75% or 100%. They return that premium to you. There's no free lunches in the insurance space. So the only way that they can do that and still be profitable as a company is to overcharge you for that premium, which is a version of a pitch that you could make for permanent life insurance. And so I guarantee you that we could find cheaper insurance, Banner Life or other things. It doesn't even have to be a convertible term option. And so you look at the difference, and if we found that difference, you could put that money into the S&P, assume whatever rate of return that you want, and I would almost guarantee whatever assumption that we used, you would have more money after 10, 20, 25 years than the return of premium. But I also know that most people would never do that. So there's value in being able to say, hey, get insurance, and oh, by the way, 99% of the time you're not going to die, you're going to get something. And so in their head, they can be like, so I just want to acknowledge that you're actually making a point to a permanent life insurance, whether you know it or not, with return of premium versus term, because you could just say, I'm going to give my clients the cheapest way to protect themselves 20 years, and I'm going to help them invest the difference. And oh, by the way, in 20 years, they got that term insurance, and instead of just getting a return of premium, they have twice as much as what they put in.
Sure. So with some of my more educated or sophisticated clients who usually don't get the insurance from me, they'll say, why would I not buy straight term insurance and invest the difference? And I respond to them, well, if you're an experienced and astute investor, you should do that.
Cool.
You shouldn't get this term ROP policy, because term ROP is great if you don't know anything about investing, or if you don't know a place to park your money where it's going to earn some type of return. Yes, you are getting 100%, with certain carriers, you are getting 100% of your premium back at the end. You're not getting any return on that. And in 30 years, what a lot of clients don't understand is that's going to get eaten away by inflation.
Totally.
So in 30 years,
yeah.
In 30 years, that $30,000 might only be worth $15,000 if you factor in inflation. So, I'm upfront with my clients if they ask me, why would I not just buy term and invest the rest? And I say, if you're an educated, astute investor, I 100% agree with you. That's what I've done myself. I got a term policy on myself in my late 20s for $500,000, and didn't know that there was the return of premium option. If I would have known about it, I still wouldn't have got it, just because I'm an investing nerd, and I would have done the only thing I agree with Dave Ramsey is buy term and invest the rest.
Amazing. Let's dive in. Let's dive into point number one. Number one, and then we'll because I don't want to derail too much. So you got 4 points, and
yes, sir.
I don't, by the way, not scripted. I think that's pretty obvious to date.
Yes.
And let's dive in, and I'm very much looking forward to this discussion.
Sure. So my ideas, my personal investment strategies, or where I store my wealth, it depends completely on what segment of the business cycle we're currently in. This does not work if you don't understand the 4 segments of the business cycle, or specifically how to determine which segment of the business cycle we're in. So as you know, the 4 parts of the business cycle are expansion, peak, recession, and trough. So you have to have a handle on that. Anyone can get a handle on that within a year or two of just, going on CNBC, Fox Business, any of the big finance outlets and reading every story on the homepage every single day. It might take you 10 or 15, 20 minutes out of your day. But if you really want to get ahead and start learning more about investing, that's one of the best ways to start. I have no formal background in finance. My degree's not in finance. That's how I learned so much about investing over the years. But it really determines what part of the business cycle that we're in. So if I want to look at my notes here, when we're in the expansionary phase of the business cycle, I'm either buying real estate, buying an S&P 500 index fund, or storing my wealth in a money market account as long as I'm able to get at least a 4 to 5% return on that. Now, money market accounts are not always a great investment, depending on what cycle of the business cycle we're in. Same thing with real estate and S&P 500 index funds. So when we're in the expansionary phase, I'm buying real estate, S&P 500 index, or parking my money in a money market account if I'm not, if I don't have a deal to go off to pursue, or if I just need to park my money somewhere. At the peak of the business cycle, and I can tell you the peak of our local real estate market, the absolute top was in April and May of 2022. And I'm the crazy person that sold my own house on purpose. I'm renting right now on purpose. All of my friends tell me I'm crazy.
I don't think you're crazy.
All my family tells me I'm crazy. But that house, I financed it. I only had the house for maybe 5 or 6 years. Bought it at a pretty good entry point. I bought in 2012. So I kind of missed the mark, but I didn't qualify for a nice big house in 2010 or 2011, maybe, when I could have gotten a little better deal. But bought that house for $250,000, financed the house for $250,000. And then when I caught the absolute top of our local Phoenix real estate residential market in April and May of 2022, just over 2 years ago, the house resold for over $500,000, and I got to keep the difference. So since I'm have a little bit of background in just studying investing, I intentionally liquidated all of my real estate holdings, which happened to be just my house. It was a nice little 2-story house, but it was worth a little bit of money. Liquidated that house and turned all of that cash into physical gold and silver bullion, right? Now, gold and silver, physical gold and silver. First of all, anyone invests in precious metals, please, first of all, talk to a financial advisor, because I'm not allowed to give you advice as an insurance broker. But please understand that gold and precious metal ETFs, precious metal funds, precious metal equities are a very, very bad risk, in my opinion. I used to do swing trading on some of those investments about 15 years ago. Had some gains and had some really big losses when the trends were still in my favor. With physical gold and silver bullion, it's never a buy and hold investment. If you buy and hold gold and silver, you might not make anything depending on when you have to liquidate your holdings. But if you buy gold and silver when your local residential real estate market hits an all-time high, gold, physical precious metals like gold and silver will be at a relative low. So that's what I did. I liquidated the only real estate holding I had, my house, put 6 figures into physical gold and silver. By the way, anyone watching at home, don't rob my house. I don't keep any of it here. It's all in bank vaults, so don't get any ideas. But invested in a substantial amount of physical gold and silver. And I will say my entry point was too early. I bought 2 years ago. However, in the last 2 years, my precious metal investments are already up 30%. So not great.
Dan, I'm gonna interrupt you for a second.
Yes,
just
sir.
Is this part of your point number one, or are you just giving context to? Because I want to go into, because I think it's amazing that you have these investments and philosophy. I just want to know, is this part of your point number one, or are we going to go into points on why overfunded whole life is not a good asset?
Yeah. So I just don't believe in overfunded whole life as an asset. So alternative investments such as money market accounts, physical precious metals, real estate, or S&P 500 index funds, in my opinion, will always give you a better return for your store of wealth, not referring to it as an investment. But right. For example, with a money market account, I'm not paying any interest. I'm My money is growing at least 5% if I'm parking it in a money market account. My only cost of my money being stored in the money market is the opportunity cost of what I could be doing with that money. And money market accounts are safe, they're liquid, and they're a low cost way to store money. Another reason I believe in the precious metal investment that I was touching on there is, as long as you know how to time that investment, you're going to get an outsized return on your store of wealth if you know how to time that market, versus if you just parked it in an overfunded whole life policy and you're earning that small rate of return while you're, figuring out what investment to place next. Real estate, as long as your entry point is good, you're buying at the bottom, you're liquidating at the top. There's no reason why you can't be making 10% year over year on your real estate investments. And as long as, once again, your entry point is correct and your exit point's correct, the S&P 500 has returned 10.52% over the last 30 years. And that includes the devastating recessions that we've had, like 2008, where the S&P dropped, close to 40%. So I just don't believe, and maybe you're going to win me over today. I hope you're able to open my eyes.
Better arguments. It's not looking so good for you. but do you have 4 points? You have 4 points, or is that just all in one?
Yeah. So those are the 4 different routes.
Okay, you're saying real estate, the S&P, precious metals are all better alternatives than putting your money into life insurance.
Or possibly even a straight money market account, depending on what the return is. So I believe those four places are a much better store of wealth, as long as you know what you're doing with your investments. Now, if you were to play the other side of the coin, why would you say someone who is not currently a believer, someone who thinks overfunded whole life may be unnecessary, what's your pitch to try and explain or even educate?
I'm not trying to convert you. We don't want you to take your clothes off on the BetterWealth show. But let's break that down. So number one, I just want to be very clear, and people might disagree with me on this. As a general rule, if you have less than $10,000 a year to save or invest, I don't think you should look at permanent life insurance. I'm a fan of term insurance. We may have a little bit different opinions on what type of term insurance, but at the end of the day, protect your family. Great. So I think we're very much in alignment on that. And there will be people that disagree. I have a 4-month-old baby, and I bought life insurance on her, and that's obviously less than $10,000. But like the as a child, there's maybe reasons why the premium would be lower. And you also articulated in your talk that I am very clear that insurance is not an investment. So when I hear you talk about gold and real estate and the market, I 100% agree with you. Like I think they're great investments, especially I'll retract. I think the market underperforms for most people because of human behavior, and maybe they're not working with the right person. But I do not argue the actual rate of return over that time period. And wealth, going back to the title that maybe was clickbait, you will never become wealthy putting your money into life insurance, period.
Sure.
We agree with that. So then the next question is, why am I such a fan of overfunded whole life insurance? The one thing that I think you said that we can pick apart a little bit is storing your money. You literally said like the S&P is a better place to store your money. And you could say that there's liquidity. I mean, you could sell your stocks tomorrow. So that's like, there's liquidity tied to that. So what is your definition of storage? Because we could go through the different elements of like what's important to me. And and in many cases, talk about life insurance as a financial foundation. Sure. And on a foundation, on a home, I may have even used this term in the Mr. Bird interview, but when you're talking about a foundation, it's something unsexy, it's something unmovable, it's something that's solid. And so my maybe definition of storing money is maybe a little bit more conservative. I will agree, a money market or a high yield savings account checks the box of a place that I would be totally comfortable storing my money. So we could then make the argument or have the conversation, what's better long term? But I would not feel comfortable with myself or people that I know to say, yeah, store your money because a storage or a savings is different than investment. A storage is you're saving so that you can deploy that money. And I would not put the money in the market to deploy. And here's why. Because, and an example of this is Warren Buffett sitting on a ton of money on cash. And you could be like, what an idiot. Why is he sitting? Look at the opportunity cost. Well, if that money was tied up in some type of investment, you could access that money. But usually when the opportunities are best to buy, things are down. It's buy when everyone's panicked, sell when everyone's, excited and not worried. But that doesn't work if my storage vehicle is tied to those same dynamics. So the definition for storage for me is I need something like a money market, high yield savings account, or in my case, a life insurance policy that checks those boxes. But it's not just to keep in the life insurance period, because I would very much say that underperforms investing, and life insurance by default is not an investment. So I'll pause there. There's many other points that I want to make, but want to just hear your thought process. And do you agree with me, or do you push back in some of those areas?
Yeah. So I look at an investment as anything that's going to pay me a return. So even a savings, a terrible savings account that's paying you 0.5%, that in some way is a type of investment. Of course, it's not. You don't want to park your money in anything earning less than, in my opinion, at least 5% APY a year, 5% return on your investment. So when I'm looking at a money market, or what I do with physical precious metals, or how I've moved my money around with residential real estate, what kind of return that's paying me, that's how I determine how good of an investment it is. So even though, you're very clear that overfunded whole life is not an investment, in my mind, I still look at it as an investment, because if it's not an investment, I have an opportunity cost of parking my money in that vehicle, because it could be deployed in other sectors of the market where I could be earning an outsized return.
And we'll talk about that in a second. We'll talk about that in a second. So can we, for this conversation, can we compare life insurance to high yield savings account? Let's just give high yield savings account 5%. I'm sure they're out there. My bank just called recently and said your savings account went from the high 4s to now 4%. So maybe I have to find a different bank for my business account. Yeah. But like interest rates, obviously in the last, recently spiked up, but like historically high yield savings doesn't even get 4%. Right now, as we're speaking, they do, but historically that's even high. And so are you cool because I am making the assumption, which we can talk about the borrowing against, because I'm sure that will come up. Why in the world would you borrow when you could take your money for free from a money market or a saving? But can we, for this conversation, talk about like asset, like a high yield savings, and then if this might be a huge if I can make the argument that life insurance is superior than a high yield savings account, then you would be like, yeah, I could use overfunded whole life insurance, and then I could, if I see it as being better than a high yield savings account, I could do the same thing. I could reinvest in gold, the market, real estate. Is that a fair assumption?
Sure. Yes. And to preface this, I know very little about overfunded whole life. So if you could give me a crash course, because I hear the bullet points of how small the return is, and then I'm going to minimize the death benefit and maximize what's in it for me. It just doesn't even feel like life insurance anymore.
Yeah, well, maybe we could do that at the end. I could show you some illustrations. But I'll say this: the way that we structure overfunded whole life is we are trying to, obviously, the talking points, decrease the base, increase PUA. A lot of times we have, shocker, a decreasing term rider because we're looking for cash efficiency. So in a lot of cases, we're trying to get 75 to 92% first year liquidity. Okay, so benefit number one for a savings account is you have more money than what you put in than in a life insurance in the first couple of years. In a lot of cases, our life insurance policies are breaking even year 4 to 6, which means if you cancel the policy within year 1 to 6, you have less money than what you put in. That's a problem. And we would never, ever, ever, ever suggest life insurance to someone who doesn't see the purpose of having this their entire life. So I'll say the first 7 years on a high yield savings account, far ahead than a life insurance policy. Okay. Sure. The internal rate of return, this is the and you know what internal rate of return is. This is the after commissions, all these. This is the actual rate of return. Again, nothing's guaranteed. We're dealing with whole life insurance, which unlike universal life, we're dealing with still low interest rates. We're dealing with, because insurance companies, for better or worse, move like the Titanic. And so I'm using numbers that we were quoting 3 years ago when a high yield savings account was like 1 or 2%. So just in perspective, the internal rate of return, this is the after, like at year 20, 25, this is like, I'm looking at cash. I don't care about any other benefits. We're getting anywhere from 3.5 to 4.5. And there's been many cases, including my policy projections, 5% internal rate of return. Okay. So you might look at that and go, 5%. Well, I can get a high yield savings account for 5% right now. So
sure,
they're equal. Now, the pushback is I'm using projections 3 years ago. And so historically life insurance, if historically that's only going to get better, and they all over a long period of time, life insurance IRR will outperform a bond index or a high yield savings account when it comes to long-term rate of return. Still, the savings account has you won first couple of years in liquidity, but it's pretty universal. If you structure a policy correctly, long-term, you're going to get higher return than a high yield savings account. But for this conversation, let's just assume over 30 years, it's the same. Even though if high yield savings account stays at 5%, which it's not, the rates are coming down.
Sure.
Whole life internal rate of return will be more like 7 or 8. But let's just assume they're the same. In a high yield savings account, when you store your money, you have to pay taxes, not capital gains taxes. You have to pay ordinary income tax on a high yield savings account. Hasn't been an issue unless you're storing a lot of money. Okay, and so that's an area. And then the other area is buy term invest difference. Is it fair to say, if we're looking at both of these in like a, comparing one versus the other, the permanent life insurance internal rate of return is factoring in a death benefit. By the way, this death benefit is increasing every year if it's set up properly, versus in a high yield savings account, you should buy term insurance, a temporary protection. This is last your entire life, temporary protection, which means that if we're being fair, apples to apples comparison, we need to take some of that money out of the high yield savings account to pay for that term insurance, which means that high yield savings account needs to be earning more just to keep up with the boring old life insurance over a long period of time. Are you tracking so far with what I'm saying?
Yes.
Okay. So over when you start factoring in a fee, when you start factoring in cost of insurance, and when you start factoring in taxes, I'm assuming a 30% tax rate. So obviously people that are lower income are rolling their eyes. They're like, there's no way I'm paying 30%. But there are clients of ours that live in California, live in other states, that 30% is something that is very realistic and might be on the conservative side, especially when you include state income tax as well. And so when you start factoring in that, you take a whole life insurance policy and you now need to earn 6.5, 7, 8, 9, maybe even 10% when you factor in those other things. And I'm only talking about the rate of return benefit. I'm not talking about any other benefits right now. I want to be clear from a standpoint of, I do not think life insurance is a great rate of return as an investment, but I do, like, if there was a better place that factored in those things that could give me a place to store capital, I would want to know about it. And I'm not even making the argument that you're parking your money. I'm just literally comparing apples to apples, because my next point is, why would you borrow against that? Why would you pay interest to the insurance company to use their money? Why would you do that versus a high yield savings account? You just could cash that out. So I'll hand it over to you. Let me know if you have any questions before we go on to the next point.
Sure. Yeah, no, I guess I agree with you on that point. If we're comparing overfunded whole life to a high yield savings or a money market account, that does have merits in that case. So
okay,
I think I need to take off this sweater.
No, keep it on. No, keep it on. No, yeah, no, I didn't win you over yet. No. Okay, all right.
There's a couple layers on.
Yeah, no, we're not gonna. All right. So the next question is, okay, if I just stop there, problematic. And the problematic is, Caleb, you're not gonna park your money or invest your money in a high yield savings account. That's not, like, you might call that an investment. I don't, but it's like, the idea is there's better places to put your money. Fair? Yeah. S&P and other things. Great. So most people are putting their money in a high yield savings account. They're taking it out and investing it. So their dollar is either in their high yield savings account or it's in the investment. It's either earning, let's say 5% after taxes and all this stuff. It's going to be less, assuming interest rates stay the same, which they're not, but we're being rosy, or it's in their investment. So your dollar can do one thing. Okay. It's either this or that. In a life insurance policy, I just talked about the rate of return benefits, but this is where a lot of people disagree with me or think maybe I'm too hard on the insurance space, because you're actually talking to someone that's very critical of life insurance, by the way.
Sure.
Is I don't believe life insurance, if you just look at the rate of return, makes sense in a vacuum. Let me explain. If all that mattered was the internal rate of return of life insurance and borrowing against it, I would be saying, you know what? I probably would do the high yield savings account. I could make the argument, maybe tax benefits, it might be better, but it's just like, it's not, it doesn't really move the needle for me. But when you have a permanent life insurance policy, you have a permanent death benefit that a lot of our clients do care about. And it's, from an estate standpoint, gets paid income tax free. And in most cases, when set up and used properly, it's increasing every single year. On top of that, you have some of the best creditor protections, not in every state. California is not a great state. State of Texas, the state of Florida. There's other states that potentially give you 100% creditor protection, and that's valuable. There's certain states that you could go apply for college and not even have to register and life insurance as an asset. So that gives you some of the benefits of the value of the protection aspect. But then there's other benefits like, and I know your term insurance probably has this chronic illness riders, accelerated death benefit, which essentially, we can't say that's a long-term care alternative, but it's similar in that standpoint that if God forbid something crazy happens to you health-wise, it gives you more options from that standpoint and allows you to potentially be able to spend the death benefit prematurely. And there's actually somebody that I know that is alive to this day because they used, and by the way, it wasn't whole life, it was a term insurance accelerated rider that got alternative treatment and they're alive, whereas the prognosis was pretty horrible. So it's like, again, I'm not saying that life insurance saved that person's life, but it sure created an option for them to do alternative medicine that allowed them to see more. So that's cool. But then the other aspect when it comes to just the overarching, like when you start stacking in all these benefits, safety, creditor protection, oh, by the way, it's growing. Oh, by the way, I can access my money, which we'll get to in a second. Oh, and while I access my money, I get all the benefits of insurance. So I can access my money and I still get a death benefit, God forbid something happens to me. Oh, I can access my money and still get a chronic illness rider. Oh, I can access my money and still get creditor protection. So the concept of the and is really, really key. And so what I believe is if the rate of return was the only thing that mattered, not getting super excited about life insurance, but if you start realizing the value of an actual insurance product of someone's portfolio, then it's like, wow, you're telling me I get all of those benefits and I can access my money to potentially put in the S&P or buy gold. Like, I'm super interested. Last thing I'll say before I go into borrowing is there's been a lot of studies out there by academics that look at retirement income. And I know that you're big into stock trading and all, and I'm sure you know that there's a difference when you're dealing retirement planning for people and like investing. And it's very much like, okay, retirement should really be called future cash flow planning. We are planning for future cash flow. And so what are different ways that we can do that? Well, a lot of people don't have all their money in equities. That could be a strategy, but what many people would say is the volatility is unknown, and volatility is not problematic unless you need to spend money, which is reverse compounding and something that I want to do. And so that some people use safe assets, bonds or something to not have all their money in one volatile bucket, diversification. And there's many people that are saying if you look at the returns and how life insurance works, they actually act as a better bond than having money in a bond. So for example, I could potentially save my money into life insurance over a long period of time, gives same type of returns as high yield savings account, gives me way better benefits, long-term estate benefits in the future, but I don't have to lock up all my money at the same time. And so it gives me the ability to use my money and benefits long-term. hence why I would be willing, and a lot of our clients would be willing to borrow at 4, 5, 6%. So because they understand the benefits that they're getting, not just short-term protection, but long-term when it comes to more options and increased cash flow. So it's one of those things where, in a high yield savings account, if I'm earning 5% and I'm taking that money out, that's actually costing me 5% opportunity cost. So there is an indirect loan there, but let's just say it's only earning 3%. And why would I pay 5% if I could take money at 3%? Well, that's actually a good question. If I had money at 3%, I would take that money at 3%. That's another thing that gets me in trouble. But like, I'm not dumb. Like I want to make as efficient as possible. But if all my money is in life insurance, or if a good chunk of my liquidity is in life insurance, I know that I'm making the bet that this is going to give me greater benefits than the 6% or the 5% it's going to cost me to access that money. And if that's the case, then I'm actually getting $1 benefiting me over here. But then the other thing that I'm a big, big fan of is if you're going to borrow or utilize your money, whether it's in a high yield savings account or if it's in a life insurance policy, you got to make sure whatever you're putting that money in is getting you a greater return than the cost of that using. So the cost of using a high yield savings account at 5% is 5%. The opportunity cost, if I took money at 5% and then invested in a CD at 2%, I'm like, I don't know the exact, I think it's like a negative 60% on my money. I'm literally like, could have earned 5, now I'm earning 2. Same thing goes if I'm borrowing at 5 to invest in a 4%, I just lost 20% on my money. But if I'm borrowing at 5 and earning 12%, it's a 140% return on my money. And oh, by the way, I get all the benefits of life insurance. And I just established that insurance is more than just a return aspect. There's a ton of benefits of why this benefits me in the future. The problem would be if I couldn't access my money, it's an either or. But because there's provisions that allow me to access my money, it allows me to play the long-term boring game, but still give me the ability to invest in the S&P, gold, silver, real estate. So
sure,
those are the aspects of like, if we look at a short-term high yield savings account and term win every time. But I really believe if you start looking at life insurance and understand all the benefits and actually having a permanent life insurance policy, and if it's structured properly, I think after year 10, it gets very hard to compete. And if you want, we could dive into math at another time. And like you will actually see mathematically this amping up. And then any argument or point that you make about this getting this rate of return and this getting this rate of return is kind of a moot point, because I can say yes to those same opportunities. The only thing that you have is you can say early on, I could potentially invest more than the person that does whole life insurance because it might take 3 or 4 years to have all the money than what I put in, versus in a high yield savings account, you'll have more of that up front. But you and I both would agree that you shouldn't invest every single penny or all your liquidity into one thing. Like there's an aspect of that. So again, I want to hear your thoughts, and I know that this may be super intense. I'm an intense person, but I actually really, really appreciate you coming on, because this is the type of content that I think super, super valuable. And I want you to pick apart what I'm saying or ask follow-up questions, because I sometimes don't realize, like, I might be saying something that makes no sense, but it might make sense to me. And so you're actually helping me and you're helping our audience by asking clarifying questions.
Yeah. Appreciate you having me on for the interview. I do have a question for you. Do you believe there's an instance where using overfunded whole life as a store of wealth, just a place to park your money, just so you're earning a small rate of return with tax advantages, and then buying term, a sizable term policy to protect your family, so you get a larger, much larger death benefit?
Totally.
Do you think of that?
I do that all the time. I'm glad you mentioned that, because mixing whole life insurance for protection and savings, bad idea. You can only optimize for one thing. So, I'm a big fan of, if we're looking for storehouse of capital, I'm reverse engineering from the premium, from how much you can contribute. And so let's say that number is 20,000. Okay, let's make sure that we're optimizing that policy. But then, oh, by the way, if you don't have any protection, I'm actually doing you a disservice if I'm not having the conversation about like how much life insurance you should want in your life. Maybe that number's 2 million, but maybe the contribution that we talked about only gets you $500,000. Well, then what we need to have the conversation is, how do we buy a separate policy that gets you term insurance? That I am a fan of converting term, because I'm a fan of more options versus less. It's kind of like you'll get this from a poker reference. If I can see cards for free, I'm going to stay in because there's more opportunities. Or if I can be low stakes, if it's only $1 to see I'm open to it. But if someone's trying to get me to raise me, then it gets me. So like more options is better than less options, and that's how I very much view financial life. Is I want to give myself and our clients more options versus less, because I don't know what the future holds, but I know that the person with more options hopefully will win in the end. Now, the thing that we have to be really honest with is sometimes more optionality and more control is a bad thing. I interviewed Ted Benna, who's the person that's credited for discovering the 401k. It was an awesome. I love the guy. And I asked him a question, and I love the way he answered it. I asked him about what he loves about the 401k. And he said what he loves most about the 401k is the restrictions and how it's difficult to get to your money. He's like, Caleb, this is so good because and he's right. Majority of people will take and spend that money. And so it makes it tough, which means there'll be something in the future, which is funny because the same people that want to work with me hate the restrictions. They're like, I believe my ability to make actions is better than some mutual fund with potentially high fees. So it's just funny. It's like there's no right scenario. It just is interesting, the different philosophies, and I can appreciate both. And I can say majority of people would be better off locking their money, never touching it, and thanking somebody in the future. Just look at history. Most people don't have money right now. That's a problem. But the people that are watching this channel, people that are normally interested in overfunded whole life insurance, usually aren't just parking it to invest long term. Usually they're looking at it for the points that I made. The last thing I'll say is, I probably said last time, I'll say a lot of times, so I apologize, is the life insurance in general. There are people that use a different philosophy than I do, but they look at life insurance as a bond alternative. And they literally they'll fund into a life insurance policy with no intention to borrow against it or use that money till they hit retirement. And we could agree to disagree. Obviously, that's some people come to us and that's what they want to do. Great. And so that would be the only area that I think you could justify, not using life insurance. It's still making sense, but you're looking at it from a retirement income game, less of like a investment return. I think most people would agree that life insurance is not an investment. Hence why I'm not a fan of IUL, because I feel like it can be way oversold. I 100% agree with you. Don't try to mix an insurance and investment product. You are not going to be happy in the end. I think it's going to be very deceiving and let a lot of people down. And I think if you're going to invest. Don't try to do it with an expensive insurance wrapper. And so we're agreeing there. And I also think IULs look way better than whole life on paper, but I don't think that's going to be the reality for most people. And so I'm a fan of let's under promise and not try to sell the moon. Hence why whole life is actually unsexy right now with high interest rates. The internal rate of return has not caught up with the interest rate adjustment. So I know I poured a ton. I'm not sure if the shirt's staying on or off, but
you know what? With your permission, would take us off. I'm getting hot and sweaty. I had to crank the AC way down in my house.
There you go. What's that? Overfunded whole life has its merits. Oh wow, yeah. Was not expecting that. I normally, there's very few conversations that usually it's one side versus the other, and so I appreciate your humility coming to this. And I want you to know that no point that you made, I think I disagree with. So I love the conversations that we can talk through. And so, yeah, I want to hand it back over to you.
Sure. I was going to say, I did come prepared. There's another shirt on under this. I'm not going to take this one off because you did make some points, but I will flash the camera here. I had a third shirt on.
Well, so let me ask you this. What would make you a whole life believer? An overfunded whole life believer?
For the right client, I think it is a good idea. I think it is, I'll just take this off. I'm really hot. So for the right client with a particular investment strategy or a way to store wealth, you have made some amazing points today. I have not experienced an overfunded whole life, and that was one of the reasons I wanted to have this conversation with you, just to kind of open my eyes and expand my horizons to what else is out there other than the space that I specialize in insurance, and the space that I have a pretty good handle on in terms of investments and where I store my wealth. So this has been a really constructive conversation. I didn't think I was going to be taking off that sweater. I thought for sure that these shirts are never going to see the light of day. And this took effort to make these up for this interview, Caleb.
Is that just a sticker, or is that?
No, I made these shirts last night. This took like 3 hours to make this shirt, and the pink one only got 10 seconds of camera time, and it's already in the trim.
Wow. Well, thank you. No, you should wear that around Gilbert, and you might get some eyeballs. You might get some weird looks.
Maybe.
I want to thank you. I'm just gonna plug what we're doing. Like, if you appreciate conversations like this, if you're like, hey, Dan did not represent our side very well, he caved way too quick. Reach out. Like I let's have conversations. Let's dive into the numbers. I want to have I want to host debates. There's a huge debate around whole life versus IUL. We'd love to host more of those. There's conversations around investments. I want this channel to not just be a life insurance channel, but like talk to people, like people that believe in S&P, and then maybe people that can justify assets under management and like why you should work with an advisor. And my hope is there's a YouTube channel called the Jubilee, and it's like they bring on people that disagree, conservatives versus liberals, or like homeschoolers versus public schoolers, or flat earth versus rounder. And it's like they have conversations, and I think it's awesome because I'm a fan of freedom of speech, and I'm a fan of like more conversations better than less. And the only way that I can live that out is actually bring people on that might disagree or push back, and in some cases might destroy me when it comes to the points that they're making. And so I just want you to know, because of your bravery, I think people are better off. I want to thank you for sharing your story, and I'm so grateful that you are alive. I'm so grateful that you're willing to share your story, and I think that there's a lot of people that are going to be encouraged just by the humility that you came, because you're a good example of taking a troll potential who made a comment that was like, oh, that was not very nice, to someone that's literally like had a very, very pleasant conversation. And like our country would be a way better place if we had more dialogue like this. And that's thanks to you. Like, you made that happen. And so thank you. And if you're watching this and you appreciate what we do, like subscribing, leave a comment. Like, it tells YouTube that you're appreciating this content. And please let us know like what we can do more content around. Dan, I'll hand over the final words to you.
Yeah, I wanted to add in one more thing, and feel free to cut this out if you need to. I wanted to plug my own tiny YouTube channel. It does not compete with you. Doesn't compete with you in any way. It's for entertainment. So my YouTube channel we just relaunched over the weekend. Only got 3 videos up right now. It's called Green Pay Stackers, not the football team, the cash reference. Green Pay Stackers. And what we're focusing on is I run a couple videos of live dials showing the behind the scenes of what a day in the life of an agent or a broker is actually like, because calls don't always go well. And the calls that go very poorly, those are the ones that I put up on my channel because they're very entertaining. And then also we're doing a big push into the dumbest concept I could possibly think of to get attention for my channel. And I've already uploaded the first video. I think it was yesterday morning. Life insurance music videos. So please check it out. It'll be the dumbest video you've ever seen. They're YouTube shorts. The first one I uploaded, I'm singing Natalie Imbruglia. Totally rewrote the words, the lyrics of the song. We're going to be dropping 3 life insurance music videos, YouTube shorts every single week, just to try and entertain and, put a little bit bigger spotlight on this wonderful industry that we're a part of.
Love that. Please reach out to us with your link so that we get the proper link. We'll put that in the description. And sure. Dan, thank you, and look forward to future conversations.
Thank you, Caleb, and God bless.